Good morning, everyone. It's Cesar Farfan here at Perennial, Head of Retail Distribution. Thank you very much for joining us this morning on our webinar, on our live webinar, that is, Protection in a Downturn. Volatility is cheap and valuations are looking stretched. I'm here accompanied by my colleague Dan Boscher, Portfolio Manager for Wealth Defender. Before passing on to Dan, I might just touch on a few housekeeping issues. You should be able to see at the top right-hand side of your screen, there is a little dashboard. You're all muted, so we can't hear you. If you want to close that window, you can press the orange arrow. And should you like to ask any questions, if you move down that dashboard, you'll see a question window which you can pop open and type your question in. We'll be addressing those questions towards the end of the webinar, so we'll allow for about 5 to 10 minutes at the end, and then we'll address those. So what we'll also do at the end is once the webinar's over, we'll be providing, you'll receive an email with a copy of the presentation and also a recording of the webinar. So thank you very much again for joining us, and I'll pass on to Dan Boscher.
All right, thanks Cesar. Thanks everyone for taking the time to join us. So what we're going to do today is a bit of an introduction to Wealth Defender and talk to both the shares component and the protection component. And what I'll do is speak for about 20 minutes, and as Cesar said, take some questions towards the end. So the first slide there, what is Wealth Defender? Really, what we're trying to do in Wealth Defender is trying to provide some risk-adjusted returns to equity investors, so equity-like returns but with significantly less risk. That's the objective, and over the 3.5 years we have had some difficult periods and some quite good periods, as we've seen in the last 12 months, but really the objective, as you can see on the slide here, number 4, is to outperform the ASX 300 accumulation index through the market cycle. You can see what we talk about there on the bottom with the bar is the portfolio itself is equities component, dynamic protection strategies, and cash. Really the most important thing to start with is the equities piece is the traditional perennial value style of investing. So Perennial is an experienced and well-known fund manager with about 16 years of investment experience, and most people would know the value style that John Murray runs here, and that is really the underlying basis of the portfolio of shares that we have. The protection piece is really analogous to, you might call, an insurance policy. So our objective here is to try and mitigate some of the downside in equity markets when they occur invariably, as they will. We use index options to create that outcome where we create a positive P&L in falling markets, and the ancillary benefit from running those strategies inside this portfolio is we get a reduced volatility in the portfolio overall. In the following slide, you'll see the perennial value business is obviously fairly substantial, running about $5 billion worth of risk. Importantly, on the bottom right-hand side, you'll see that the overlay business, which we call, which is essentially the protection piece, is significant inside perennial value. It's not a startup. We have institutional mandates that run overlays as well in order to protect downside, just as we do in the retail products that we run. Turning on to the next slide, the team that we have here is very experienced. We're not running an algorithm to try and protect the portfolio like many of the other products in the market that use algos to essentially de-risk. We have a 4-person team with an average experience of over 16 years, and all having traded derivatives and managed risk for long periods of time on both the buy and sell sides. Turning to the following slide, the diversification dilemma. What we're going to talk about here is briefly touch on some of the traditional forms of risk management, and importantly, what I wanted to sort of leave with leave people with is the understanding that traditional risk management, whilst is effective in most markets, isn't always effective and doesn't always work. What we really want to do in Wealth Defender is provide something that we know is going to work when markets fall, rather than we hope is going to work with markets when markets fall. And on this, what I want to talk about first is what we see as the traditional form of risk management, which many of you will know as 60-40 portfolio balance. And in theory, that makes perfect sense. And Markowitz, designed this in the 60s, and it's been well adopted for good reasons. But what we wanted to do is just draw people's attention to the fact that it doesn't always work. And this slide here that you'll see on page 8 really is an example of that. What we see is the biggest drawdowns across different countries in 60-40 portfolios over time. And you can see that in Australia, towards the right-hand side, the largest drawdown was 29%. And you can also see that a significant number of years have to pass before portfolios return to their original balance. The second and common version of risk management is simple diversification, which is also quite sensible. Allocating assets across different risk classes is sensible in the most part, but again doesn't always work. What we can see here is a chart that shows the performance of different asset classes in both 2008 and 2009. You remember 2008 was a very negative year, and on the bottom of that chart you'll see all asset classes were negative. In 2009, markets ran from March, and you can see the top part of that chart in the light blue, all asset classes were positive. So, the correlation there is obvious, and the diversification impact is not helpful in that scenario. Returning briefly to 60-40 and talking about bonds and equities as diversifiers against each other, what we can see here is a chart which again looks at many different countries, but it shows the portfolio variability by equities and bonds. What you can see if you look to the right-hand side for Australia is that over 90% of the variability in equity in balanced portfolios, 60-40 portfolios, comes from the equity piece, which is a lot higher than most people would think intuitively. What it means is that if you're becoming, I guess, bearish or nervous on markets and you want to reweight somewhat, increasing the allocation to bonds is really not going to have a lot of difference, not really going to make a lot of difference to the outcome relative to changing the stock allocation in a portfolio. Now, obviously, in a bull market fueled by QE and where economies generally seem to be getting better, decreasing your stock allocation is a difficult thing to do when your underlying clients are looking for CPI plus 5 or whatever it is that they're looking for. In terms of where we are now, Wealth Defender is really in a good position now in terms of it becoming more and more attractive to people as markets have rallied so strongly. And secondly, what we'll see in a minute is that the underlying tools that we use in Wealth Defender, being options, are very attractively priced now, given that volatility itself is so low. But talking about the equity markets briefly, we know we've had a significant rally from 2009. This chart doesn't necessarily look that scary, but it's clear that globally PEs are above the long-term averages, and whilst they rallied significantly higher in 2000, I think that's probably, the tech bubble was a different scenario than what we've got now. The FANGs, Facebook, Google, etc., are only a portion of the rally we've seen in the last little while. We don't have a CAPE chart here, but the CAPE ratio, which looks at the previous 10 years reported earnings adjusted for inflation, shows a significantly higher significantly higher current PE to its long-run average, which also concerns us a little bit. In Australia, we're definitely towards the top of our range. You can see this in chart 13, that the long-term PE of around 14 times is nearly one standard deviation below where we are now. So it is somewhat not concerning, but it is certainly, you know, a better time than we've seen in the last 5 or 10 years to take out protection in our view. Following that, on the next slide, as I said before, the tools that we use to take out protection is really equity derivatives or options. So we buy put options. We actually manage a portfolio of options in a dynamic way to try and reduce the cost over time, which is one of the key, I guess, added value pieces of the portfolio. But as a proxy for the cost of optionality, you can see the VIX chart here, which goes back all the way to 28, shows that VIX itself, or volatility, or the price of volatility, is extraordinarily low in terms of its long-term prices. So that's a good time for us, we think, to take out protection in the context of the markets having rallied as far as they have. I wanted to talk a little bit about correlations on page 15. We talked a bit about 60-40 portfolios already. One of the diversifying effects in a 60-40 portfolio obviously is bonds versus equities, and sometimes that works well and sometimes it doesn't. The correlation between bonds and equities is variable over time. It's not always negative, and what that means is that sometimes you get drawdowns in both bonds and equities, and we've seen that recently as well. On page 15 we can see VIX versus the world market index, and this is a correlation chart, and it shows you a correlation of currently of negative 0.65, which is a reasonably negative correlation that's significant. And what it means is that when markets fall, when you see the chart there, it's called MXWO, which is a MSCI World Index. When markets fall, the volatility, or VIX, rallies strongly. I mean, that's kind of intuitive, but the point that is important about this chart is that it's constantly negative. We see that during a significant number of market cycles from 1990 through to now, that VIX and market world indices are correlation negative, which is essentially saying that when markets fall, volatility rises, and that's analogous to us saying that when markets fall, owning put options is going to help you mitigate some of that loss. Unlike a 60-40 portfolio, for example, where we kind of hope it's going to work, or diversifying into asset classes, which we will say we're going to hope it's going to work. This is something that we really believe does. And in terms of the results for Wealth Defender so far, we'll talk about a couple of the moves down we've seen in markets so far, but on the chart, you'll see here, chart 17, you'll see that over the since inception period of about 3.5 years, Wealth Defender's up about 5% in a market that's up about 7%. Equity-like returns with significantly less volatility is what we're trying to achieve, and in terms of the volatility reduction that has been achieved, you'll see in the bottom row on the right-hand side, volatility in this fund is 20% lower than it is in the market, which to us seems to be a strong selling point. In terms of value investing and the stock component of this portfolio, you'll notice the row that says shares portfolio since inception is up 7.7, and S&P 300 is up 7.2, a very mild outperformance. Part of the concept behind Wealth Defender is that what we spend on protection gets repaid by the alpha that we create in picking stocks. You'll see that since inception the portfolio is 2% behind the market, and partly this is due to the fact that the stock performance hasn't been as good as we would have hoped so far. The long run stock alpha and perennial value over 16, 17 years is about 2.5%. And what we've seen in the last 5 years is value investing has been a relatively difficult place to be, with bond yields having fallen over time. That makes value investing a more difficult spot, but what we've seen now is that starting to turn. Whilst we still have parts of the market that are very expensive, and we don't participate in high growth stocks with very high multiples, whilst they've run, we have seen in the last 6 to 12 months the value cycle starting to turn. So we're expecting to see that stock alpha start to kick up a bit, which will help mitigate what we've seen in terms of the protection cost. Since inception, you'll see there it's 2.6%. We target a 1 to 2% band for protection costs, so we're slightly outside that, but notwithstanding that, we see that as being significantly lower than what a retail investor would be able to achieve just by buying put options out of the screens themselves. Importantly, what are we getting for that cost of protection? What we can see here on slide 18 is a bunch of examples of what the option portfolio did when markets fell. The key, I guess the biggest and most obvious one, is to look at the August 15 low. You'll see that row there where the market was down 11.7%. The protection portfolio was up 4.3%, so mitigating nearly 40% of that loss. There are a bunch of other examples showing that mitigation, being in the 30% range. None of these falls, 5%, 5%, 7, 11, 5, and 8, are really what we would call significant market falls. What we will find with the portfolio, given the way the optionality works and the convexity in it, is that percentage of market falls saved will get bigger and bigger as the market gets worse and worse. So we haven't really seen a significant sell-off yet, although maybe you could call 11% significant, but it's certainly getting there. But what we do know is that every time the market falls, we make money in that book, and the further the market falls, the more percentage of fall saved we seem to see. And that's no surprise to us, of course, but it's good to see it demonstrated there. Just finally on volatility itself, a little bit of a closer snapshot relative to the earlier, nearly 100-year chart that I showed you, and more relevantly, Aussie vol itself. So this is the AVIX, which is the Aussie version of VIX, and again, it's a proxy for the cost of options. You can see in the orange line, since inception of the unit trust to financial 16, the end of financial year 16, volatility rallied and was quite significant in that period in the financial year 16 period, as markets sold off across a number of events. And actually we performed quite well in the option book in that early part. Financial 16 was much more difficult. Financial 16 was much more difficult, but now in the yellow you'll see financial 17 option prices, or VIX, have come right back, and we see that as being a good position now for people to reallocate away from equities, or at least add some protection to their overall portfolio. So for us, the key question is, what should investors be doing right now? With the equities exposure having increased in portfolios just by nature of equities having rallied so far, and PEs being relatively higher than they have been and volatility being low, it seems to us like a reasonably sensible idea to allocate some of the equity funds that people run into strategies like this that still have the equity participation but do have a significant outlier in the fact that it has protection qualities within it. So ideally what you'll have is the ability to participate in the last piece of the rallying market in a lower volatile way, but also be able to have some protection when markets fall, which invariably they do. So it certainly suits those people wanting to sort of squeeze the last few drops out of the lemon in the equity markets, as it were, and people who need to continue to grow their balance, but as well, it does suit people who are looking to protect their portfolios around retirement. So sort of satisfies in many ways both those sequencing and longevity risk issues that investors have today. Over the last 12 months, The unit trust is up 13% in the market. It's up 15%, which is, as you can see there, an 87% participation rate. For a protection strategy in a market that's rallied so high, that's, in our view, quite a good result. And we don't know how much more the market has to rally, but if we can keep up like that, we should be reasonably happy, particularly when you consider that we've got the downside built into the portfolio, such that if we do get a short, sharp fall, we're going to have a significant outperformance against the market and protect people's capital and satisfy our original objective, which is outperforming the ASX 300 through all market cycles. So with that, I'll finish, and we'll move over to questions.
Thank you very much, Dan. I haven't seen any questions being typed up, but we do have a little bit of time left. Feel free to type any questions. In the meantime, I might ask Dan a question. So Dan, clearly volatility's collapsed and valuations arguably are looking somewhat stretched. So I guess as an investor, potentially, let's say a retiree, I've got this dilemma where interest rates are very low and potentially equities are stretched, but I like my equities because I like my divvies. What should I be doing in this environment?
Well, with interest rates so low, it's hard to move out of equities, right? Particularly if you've got, CPI plus 4 or 5 kind of target. So I can see why markets are continuing to rally. Monetary policy is still very dovish. Central banks are still outside of the US purchasing assets. So there's a lot of reasons to feel like the market could keep going, but it also is becoming, increasingly difficult to hold on for the last piece. So, I would certainly not advocate selling equities because the market's about to fall significantly, or selling equities because we think PEs are above their long-term averages, particularly in the face of having to meet those objectives. So in our view, adding protection to a portfolio at this part of the cycle, particularly with vol at this level, is a no-brainer.
Thanks, Dan. And if I might slip another question in there, we obviously saw the RBA hold rates yesterday again, and we actually there is a question that's come through. This is from Simon. Hi, Dan. Is there any catalysts do you see for markets turning?
Oh, well, there's lots of catalysts for that, Simon. The problem with the catalyst is that you don't actually know when it's going to hit the tape, or if it's going to hit the tape at all. But I would split catalysts for markets turning into 2 pieces. One would be macroeconomics, and one would be geopolitical. So in the macroeconomics part, I don't see a reason for markets to turn. Globally, macro has been positive. GDP growth has been positive and increasingly positive. PMIs are all very strong. Unemployment globally, well, certainly in G7 is low. Rates are low, which is stimulatory, and we haven't seen any kind of blow off the top in inflation anywhere. So in that context, that all bodes really quite well for equity markets. Having said that, on the geopolitical side, there are a long list of potential problems that could turn markets in a heartbeat. Some of those would include North Korea, the US-Russia election probe, the increasing populist nationalism sort of movements around particularly Europe, Islamic State, Brexit, just to name a few. So any of those things could happen at any minute to push the markets over. So, we can watch them, but, we can't predict when that's going to happen, which is one of the reasons why we like the strategy in Wealth Defender, because we're not trying to time the market turn here. We're carrying protection all the time for that time when it does happen, which is a little bit different to some of the other products in the space where futures are used to hedge against market moves, where those strategies essentially have to wait for volatility to increase before they turn on. So when vol's really low, like now, they're not on, essentially, which means if we get an unexpected overnight geopolitical risk, they're not really going to do much to mitigate that downside. So that's one of the key differences with Wealth Defender that we really like. So that would be the answer to that question, Simon.
Thanks, Simon, for that question, and thanks, Dan, for addressing that. Look, unless we have any other questions on that note, we might just wind up. Once again, thank you for attending our webinar, and keep an eye out on your inbox. You will be receiving a copy of the presentation, and have a great day and a Merry Christmas. Thank you very much.
Thank you.